This is a short presentation based off of some of the information found in the book Unconventional Investing by Tim Higgins and Michael Hayjack, in addition to some of the information presented in the seminars based off of the book. My name's Tim Higgins. I have a couple of books on Amazon, and in addition to those books, as I already mentioned, I do speak regularly on the information found within my books, and you can find a list of speaking engagements at unconventional-investing.com. What I want to address and touch upon are just some tip of the iceberg issues facing most people that they may not even be aware of, and their issues as to why we need to explore less conventional or unconventional solutions given the current environment that we're in. The biggest issue for all investors is the emotional component of money and seeing statements move up and down. A research firm, Dalbar, puts out studies looking at rolling 20-year returns every single year. The results are always somewhat the same, and it goes something like this. The S&P 500, which is, let's just call it the US stock market, over a 20-year time frame, had averaged at one point little over 9%. The next bar graph you're seeing there is almost half of that amount, and that is the average equity or stock investor, meaning that the average investor is getting almost, or just a little bit above, half of the return of the stock market. That's a dramatic reduction in returns. It's not just the stock market. Let's look at the rolling returns for the bond market, 5.74%. The average fixed income or bond investor is getting under 1%. Why is that? Human emotions. We all go up and down the roller coaster here. When things are going really well, we want in. We want to put more money into the market as it gets more and more expensive. As the market comes down, as it always does, typically every 7 to 9 years, we actually want to remove the money at the lowest point, because we want to get out and end the quote-unquote pain, whether it's real or not, paper losses or realized losses. But this is the roller coaster that everybody goes on, and this is what's pushing the hot button, your emotional button, to make decisions at the wrong time. We all know logically we want to buy low, sell high. Emotionally, we're driven, which is a much more powerful force than logic, to do the exact opposite. Hence, half the returns, or even less than that, in terms of the bond market on those rolling 20-year statistics. So how do we combat this? That's what really the seminars and the book goes into. To give you just a feel for very high level, we need more diversification, and I'm going to go into what we don't need. We need alternative strategies, ways to hedge against the market. Using a sports analogy, play offense and defense. Defense in a declining market. We need more control, more flexibility within our investments. Again, just statistics showing the fund flows or money coming into funds at various times and going out. The two circles just show you, again, reiterating this theme. When was the most money going into the stock market? At the peak of the tech bubble. When was the most money coming out of the market? At the very bottom of the bear market in 2008, 2009. Buying high, selling low, doing the exact opposite of what we should be doing. Here's an interesting conversation, and Daniel Kahneman won the Nobel Prize based off of his studies in behavioral finance, and if I were to offer you the opportunity on the flip of a coin to win some money, and let's say you have to put up $100 on that bet, do I just have to pay you or match you $100 for you to take me up on that bet? What Kahneman found was that people need to be paid 1.5 to 2.5 times that amount of money to take that bet. What does that mean? They don't want to lose the money they have. Losses are 2 times as powerful, that emotional trigger, 2 times as powerful as the gains. And the reason why I touch upon this is number one, acknowledging that emotions and investing are directly linked, and we need to combat that, hopefully, with strategic technical strategies that are as unemotional as possible. But number two, Wall Street ignores this. So typically, speaking in generalities, we are told to buy and hold, do nothing in declining markets, and only utilize strategies that we hope for appreciation on. They're ignoring what's most important to us, the individual investor, and that's the downside. We want to play defense. Any good sports team would tell you you have to play good defense in addition to good offense. And actually, it means more to us. And what Kahneman is telling us is it means twice as much to us. Conventional strategies don't address that. And I'll just go back to the previous slide. Thinking that this is a diversified portfolio, go into your 401k where you see a nice menu of some large cap, mid cap, small cap, international stocks, thinking that they're going to do different things for you. You're told that you need to be diversified, and you're handed a portfolio that looks like this. Well, 3 out of the 4 of these asset classes are extremely correlated. They're all going to do the same thing. In fact, I go to Vegas and place a bet that if one market was down, all 3 of those would be down, or in the case of these 4 asset classes, all 4 of these are down that specific day. Things are moving in unison now, at least with these core asset classes. This is not diversification. You're being told it is, but it's not. So we need to adapt. So we need more diversification, we need alternatives, and we need to be more flexible and nimble, especially to be able to play defense. So this is a huge issue facing a lot of people. Emotions, high correlation within asset classes. So if things are highly correlated and we hit another 2008, what's going to prevent it? Nobody wants to go through this. This is like turbulence on an airplane. Nobody enjoys that, right? When it goes down, if we see something similar to 2008, is that cookie cutter portfolio going to save us? Is it going to protect us through diversification? Most likely not. Another part of my book addressing mutual funds, are mutual fund managers going to protect us? Most likely not. I hired a manager. Aren't they going to get more defensive? 9 out of 10 funds probably wouldn't, because in their prospectus they have to be close to fully invested in their little unique compartmentalized asset class and can't deviate to more conservative strategies. They can't play defense. Not all, but a lot of them, most of them can't. We need to think outside the box. We need to look for more better solutions. So this brings us to the current equation, the current environment that we're in. In the conventional asset classes of stocks, bonds, and cash, what cookie cutter portfolios are recommending or have recommended throughout time puts us in a little bit of a predicament if this is all we're going to limit ourselves to. Why? Especially for retirees. This is a very tricky situation. Remember when cash was paying 5% FDIC insured, you could live off of interest? Pays nothing now. Thank you, Federal Reserve. So unfortunately, it's pushing people that are conservative into more aggressive asset classes. How about bonds? They're conservative, right? Well, yes and no. They're more conservative typically than stocks. However, we've had over a 3-decade bull run in bonds. Why? Because interest rates have declined. Remember when interest rates were in the mid-teens for your mortgage in 1979, 1980? Or you could get FDIC insured CDs, double digits at the bank. Since then, they've declined. Declining interest rates have been bullish or have buoyed bonds in their prices. And therefore, there's been appreciation in bonds in addition to the income. Well, what happens if we're on the ground floor of interest rates? What happens if they start to raise rates? Keep your ear to the ground on this one, because the Fed's always talking about it, and they're scared to do it, but they're talking about raising rates. Some are talking about going negative interest rates, and that's a whole different conversation. But if rates rise and quote unquote, as Alan Greenspan said, normalize, meaning they're not normal right now, but if they do go back to normal rates, bonds are going to go down in price. Okay, cash pays nothing. Bonds are going down or are now more risky than ever. That's pushing us into stocks, which isn't necessarily good or bad. But if stocks are expensive, that may be a problem. If they're cheap, okay, well, that's not so bad. One way to gauge how expensive stocks are, one way, are PE ratios, price to earnings. One analogy I use, keep in mind it's not a perfect analogy, but to help walk people through the concept, many people can visualize rental real estate or something tangible like real estate. And let's assume you can buy you inherited some money, you can buy your neighbor's house, so real estate you're familiar with, your neighbor's house in cash. And typically, what you can collect in rent isn't based on the price you paid, it's based on the location and size of the home. So let's just assume your neighbor's house can generate $3,000 a month in rent or 36 grand a year. Well, if you pay with your inheritance $500,000 for that property, price you paid over the earnings it's generating, here's just, giving you a feel for what a PE ratio may look like. It's just a calculation. So that may be 13.89. Well, what if you paid $1 million for it? It's a higher price to the earnings, so a much higher PE, indicating it was more expensive. And if you paid a lower price, a lower PE. Well, let's take that to the stock market one step further. So one PE ratio, now there are forward PE ratios, 1 year look back PE ratios, and there's also a famous one put out by Yale Professor Schiller, the CAPE ratio, cyclically adjusted PE, looking at a 10-year rolling PE number. This is just one example of a PE ratio, but as we look back over a century, and now that we're currently in the mid-20s, we've only been at this point a few times. 1929, Great Depression, the tech bubble was very interesting, and let's talk about that in the PE world. Prices, we were paying super high prices for internet companies that had no earnings, so hence super high PEs. Then we had the housing bubble, and now we're back in that territory. We bounced off the average for that about a little over 100 years. Now we're back at an elevated level. Some would argue that it's not elevated compared to the last 20 or so years. Okay, bottom line, it's not cheap. And even Janet Yellen in 2015 came out saying that the valuations were high in the stock market. Does that mean it's going to go down immediately? No. Can it go higher? Absolutely. But going back to our previous equation of cash, bonds, and stocks, if everybody's being funneled into or encouraged to put into more aggressive asset classes, just know that the U.S. stock market isn't necessarily cheap at this point in time. Many would argue it's very expensive, but I don't want to go to extremes. Just to let you know, it's not cheap. So if it's not cheap, what can we do about that? And that's the bottom line. This is the conventional world. 60-40 portfolios, or that cookie cutter 70-30 tailored to some very basic questions on the risk tolerance questionnaire from a financial magazine. Using only stocks, bonds, and cash. We need to go way beyond this, especially in this environment. And that's what the book and the class really goes into. But we need to be aware of our hurdles and headwinds before we can even explore what the solutions would be. And here's one of my pet peeves, and this is an actual 401k that I'm very familiar with, and the options within it. And I'm keeping it generic. I'm not labeling the funds within the 401k menu, but let's explore what's offered. A stable value fund, cash, pays nothing. 3 bond funds. Typically, they're all going to look somewhat the same, not really diversified bond offerings. A balance fund, which simply means a combination of stocks and bonds, that does very little for me because I can actually buy a stock fund and a bond fund, so thank you, balance fund. 8 stock funds, 3 large cap, 2 international, 1 mid, 1 small, 1 total market, which means that it would be large, mid, and small, Thank you very much. They're all going to do the same thing, all highly correlated. Just because it looks like they're providing diversified menu, it isn't. And then 12 target date retirement funds, which is the new that's the new trend. That's what 401ks are moving towards, which, in again, theory versus reality. In theory, these make sense, get more conservative as people approach their retirement dates. Reality is it's missing a key component to the equation, and that is current environment. So current environment means if you're going to be putting me into more and more bonds at a time when the end of the bond bull run is arriving and maybe the beginning of the bond bear market begins, you're not doing me any favors. So it's based on time. It's not tailored to, number one, the investor specific risk tolerance, and number two, current market conditions. So it's a nice concept, but we need to do better than this. We need to go further. So interestingly enough, this can make sense for college investing because you would be liquidating a portfolio almost immediately and spending it in at least 4 years, but typically in 1 or 2 years, depending on how much you saved. In retirement, you need this to last 20 to 30 years. So just shifting to bonds may not make the most sense. Not saying it's right or wrong, but just keep in mind that if you can go above and beyond with additional strategies, you may be better off. And all I'm doing is presenting ideas. Ideas are harmless. We should entertain them all, evaluate them all, see if it resonates with you. If you accept it, you can implement it. If you reject it, you can move on. And now you have more conviction with what you are currently doing. So where are we headed? I don't know, but I am concerned that volatility will continue, and I am concerned with Federal Reserve policies and monetary policies. And one champion for the individual investor has been John or Jack Bogle of Vanguard. And one of his quotes really resonated with me where I said, we need to be more nimble. I don't want to go through the last 17 years of ups and downs of dramatic declines. I don't need that. That's just me. But if you're willing to buy and hold through all that, okay, that could be a solution. But here's what Jack Bogle said on April of 2013 on CNBC. Prepare for at least two declines of 25 to 30%, maybe even 50% in the coming decade. So at least two, maybe three, of 25 to 50% declines. Okay, that means the environment we're in is going to continue. What we've seen over the past 17 years is going to continue. What do we want to do about it? Number one, we can explore alternatives. We can explore different asset classes, different ways to invest, maybe like college endowments. We can explore self-directed accounts. We can explore proactive tactical trading strategies. Some may, again, resonate with you. Some may not. But those are some of the options we can look into and research. They may be better than the conventional world 60-40 portfolio and just buying and holding. Okay, that is your second option. Is you could try to ride that roller coaster out if you're willing to do it. Both are going to take conviction, whether you're implementing a proactive strategy or just doing buy and hold. We need to acknowledge that emotions come into play, but we need to stick to a strict discipline. You'll be way better off. The third and worst option is winging it. Because if we wing it, it's like going on a roller coaster without being strapped in. We're going to panic at the wrong time. We're going to want to get in at the wrong time. We're going to be buying high and selling low time and time and time and time again. And it's been proven that as human, emotional beings, that's what we consistently do. So we don't want to do that. That's the worst option. So once again, the book Unconventional Investing can be found on Amazon. A list of speaking engagements can be found at unconventional-investing.com, including a blog that I do update on a monthly basis. And I'll leave you with this. All we are doing is exploring new ideas, and it is just that, an idea. If it makes sense to you and if you can implement it and it can better your portfolio, great. If you reject the idea and it gives you more conviction to continue doing what you're currently doing, great. But what we don't want to do is ignore possibilities and simply wing it, hoping that mutual fund managers or the conventional wisdom will help us in the next decade given the current headwinds that we have facing us. I don't think you'll be better off. So hopefully that helps. Hopefully it's a little bit eye-opening. Please visit the website, and hopefully I'll talk to you soon. Thank you.